Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, June 26th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. We were down 2.86% on the S&P 500 this week, and we closed at 3,009.05. The first chart that we're looking at is a one-year weekly chart of the S&P 500, so each candlestick represents 1 week of trading. And as we can see here, we closed above 3,000 for the 5th time in a row, so that's at least something to be thankful for. We continue to close above the 3,000 level on the S&P 500. However, you will see that there was a considerable amount of weakness in the market this week, so fingers crossed that we can stay above this 3,000 level going forward. But at least for 5 weeks in a row now, and for the entire month of June so far, we have been able to close above 3,000 on the S&P 500, and that, of course, is this solid horizontal blue line is set at 3,000. The blue line that varies is the 40-week or 200-day moving average. Unfortunately, we did close just a little bit below the 40-week moving average this week on the S&P 500. The 40-week is at 3025.92. We closed at 3,009.05. So it's not horrible. However, we will need to keep our eye on this because it will be important for us to continue to close above 3,000 going forward. If we come down to the 2950 level sometime next week, that's not going to be the end of the world. There is some support there, but hopefully we can stay above 3,000 going forward. The next chart that we're going to look at is a 5-day, 5-minute chart of the S&P 500. So each candlestick represents 5 minutes of trading. I like looking at this chart so we can kind of see what happened day by day. So Monday and Tuesday weren't too bad, and of course kind of fell off a cliff on Wednesday, went sideways for the most part, slightly up on Thursday. And today, unfortunately, closed towards the lows of the session, or right at the lows of the session. So for the week, we closed at the lows for the week, and for Friday, the 26th, we closed right at the lows of the session, and for today alone we were down 2.42%. So much of the damage for the week was actually done just today on Friday the 26th. So hopefully we can continue to stay above 3,000 going forward. That will be critical, and we start closing below 3,000 next week, and it might get kind of ugly. So we'll just have to keep our fingers crossed. Next, let's take a look at the performance of each individual sector of the S&P 500 for the week. And of course, we know we were down 2.86% on the S&P 500 as a whole. And we can see here that the technology sector, as it has been on a relative basis, was the strongest performing sector for the week. It was only down 0.41%, but we had things like the energy sector very weak, down 6.55% for the week. So a lot of weakness in the entire market, but the strength continues to be, on a relative basis, the technology sector. So the question becomes, can tech continue to hold up this market? The next chart that we're looking at is a 5-year weekly chart of the S&P 500. So we started off by looking at a 1-year weekly. I just wanted to pull back and give you guys a 5-year view of the S&P 500 so we can kind of see where we've come over the last 5 years. And again, we closed beneath the 40-week moving average this week, which wasn't good. But the good news is that we were able to stay, barely, but able to stay above 3,000. So far so good. Hopefully we can continue to close above 3,000, because I do feel that that will be pretty important. If we close beneath 3,000, 2,950 is the next level. And then we do have some support at 2,800. I don't have those things annotated, but just remember 2,950 and 2,800, because if the 3,000 level does not hold over the next few weeks, 2,950 and 2,800 will be the next two areas of support on the S&P 500. And now we're looking at a very similar chart, except now we're looking at the DIA for those of you that like to trade and or track the Dow Jones 30. The DIA, and we can see that the DIA has closed and pretty much traded the entire week below the 40-week moving average. So again, we're showing weakness all over the place, not just in the S&P 500, but also in the Dow 30 And then when we move over and look at the Russell 2000 by looking at the IWM, the ETF that tracks the Russell 2000, again, we can see a lot of weakness there. For several weeks now, we've been trading below the 40-week moving average. We have a downtrending 40-week. That is not good. And the price action on the Russell 2000 ETF, we were at these same price levels in the middle of 2017 on the Russell 2000. And any of you that have seen my work in the past, you know that I've pointed out that the Russell 2000 actually peaked back in August of 2018. We challenged those all-time highs at the beginning of 2020. However, we fell short. So technically, the Russell 2000 has been in a downtrend since August of 2018. Guys, we cannot have a really strong stock market with small caps not participating. As long as there's small cap weakness like we're seeing here, we're not going to have a really strong stock market. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Now what we're looking at is a chart of 2018, and I have this annotated with the Simple Market Signals signals. So these are the weekly signals that come out and are published in the newsletter. And so what we can see here is the signals, the Simple Market signals are green, yellow, and red. So I'm just going to go through this very quickly. We're going to take a look at a couple of charts, but I want you to understand how these signals work and how they can help you. So first off, we have the green signal, and the green signal is the best risk-reward signal for equity investors. And what you're going to see here is that most all upward progress in the stock market is going to be made when the signal is green. And then we have the yellow signal. Now, the yellow signal indicates change, and generally what happens is after a green signal environment, then the signal will change to yellow, and if the sell-off gets bad enough, it'll change to red. Now, in this time frame here, we had both yellow and red signals. I just kind of clumped those together just to kind of give you an indication of what happens. It's very, very hard to make money in the stock market when the signal is either yellow or red, okay? So again, most all of your upward progress in the stock market is going to happen in the green signal environments. During a yellow signal, you're either going to be sideways to slightly down is kind of the realistic expectations, but oftentimes that yellow signal will be that transition signal between a green signal environment and a red signal environment. So in 2018, we went green, we were green here, and then the signal went yellow here, and then it turned red, and we'll take a look at that here in just a second. the red signal is your worst risk reward signal for equity investors, and your worst downturns, including bear markets, happen during a red signal. And we'll take a look at this here in just a second. Now, let's focus on this time frame right here where the signal went yellow, and we're going to switch to a chart that's going to straddle from September of 2018 through March of 2019, because I want you to understand what happened here. So right here, right, we had this green period, and then the signal went yellow here. And so what we're going to do is go over here. So right here is where that signal went yellow, all right? And then a few days later, the signal went red right here, and that was in October of 2018, as you can see down here. And then we had some sideways choppy movement, and then a quick sell-off. We bottomed right here in the latter part of December, and then the market started to rally. Now, a couple of things to understand is the market will bottom during the red signal, okay? Because again, remember that simple market signals, the weekly signals, measure risk levels in the stock market. So green is your best risk-reward ratio for equity investors. Red is the worst risk-reward signal for equity investors. And a yellow signal indicates that there's change, that risk is rising, and sometimes that risk gets bad enough that that signal goes red, okay? But anyway, so we bottomed here. The market started to go up, and we can see here that the signal went back to green right here. During shorter red periods, oftentimes the red signal and the green signal come out at about the same price level, okay? And I'll show you here on another chart in just a minute that the longer the sell-off, the lower that green signal is relative to where the red signal came out, and that'll make sense here in just a second. But again, this is just based on market metrics and market internals and things that go into the model, and it's about risk levels, okay? So if you get one of these quick sell-offs that rebounds very quickly, your red signal and your green signal can be in a very similar place, okay? So just understand that simple market signals measures risk in the stock market, and as you can see here, these rally attempts, right, because this was red, right, we went red here, so you get these rally attempts that fail, and then it sells off hard, rebounds pretty quickly, and then the signal goes green here, all right? Now, we're going to pick up right here, so this, again, is that transition period right here, all right? So now we're going into 2019. This is calendar year 2019 in the S&P 500, again, daily charts. So this is that red period. The signal went green here. So you can see here when the market is green, this is the best risk-reward ratio for equity investors. And during the green periods, this is where most of your upward progress in the stock market is made. Let's move back and go back to 2007 through 2009, and now we're looking at weekly candles. And what I want you to understand is when the market goes into a prolonged bear market, what really happens here, okay? So now we're going back again. This is 2007. The signal, the weekly signal, when I back tested this, because remember, the model came together in 2017. I worked on this for 20 plus years to figure this out. Finally, all the components came together in 2017. So what we were looking at here, okay, what we're looking at here is actual data. These were the actual signals that the model generated in 2018 and going through 2018 to 2019 transition as we looked here, and then 2019. So this, however, is back testing. So the original red signal that came out during the bear market that started in 07 and ended at the beginning of 09 came out right here, all right? Again, around 1,500 on the S&P 500. And as you can see, we, sold off for a few months. We had this rally attempt that failed and then sold off hard again, bottomed, and the market started to rise, and the signal came out green here, all right? So this is what happens during longer sell-offs, during longer red periods. Your red signal and your green signal have a huge price differential. Just between here and here, the market was down about 40%. Now, if you lose 40%, guys, it takes 66% to get back to break even. All right, so just to get back to 1,500 after if you've got 875 left and you're trying to get back to 1,500, that is over a 66% gain that's going to be necessary to bring you back up to break even. All right, so this is where simple market signals can really, really help during all market phases. But if it can help you minimize your losses during downturns, regardless of whether it's a multi-year downturn that ends up being a super long bear market or a shorter downturn like this, if you can use the signals to help minimize your losses and maximize your gains, right, during the green periods, that is where this thing is really going to help you, okay? So the whole key here, and this is where most people get it wrong, is start with the stock market first. What is the overall market environment like? Whether you're trading the S&P 500 through, SPY or a mutual fund or whatever it is, or you're working in the Dow, or you're working in the triple Qs, or you're trading individual stocks or options, you need to get the stock market right first. What is the environment you're working in? Okay, are you in a green environment? Are you in a yellow environment? Are you in a red environment? Get the market environment right first, and then everything else becomes so much easier after that. The simple market signals model is built around the S&P 500. However, it doesn't matter. Whatever you're trading, whether you're trading the DIA, the triple Qs, or individual stocks, you need to understand what's going on with the S&P 500. So let's take a look here at the DIA overlaid on top of the S&P 500, and this is calendar year 2018. So we've already looked at what the S&P 500 looks like by itself, but let's overlay the DIA, the black line, okay, on top of the S&P 500 for 2018. And you can see that the signals would have been exactly the same for the DIA. Now let's roll forward to the mid period. So again, we're going from September of 18 until the end of March, beginning of April of 19, and you can see the downturn. And again, the black line is the DIA, and you can see directionally it's virtually identical to what's going on with the S&P 500. So you need to understand that whether you're trading the DIA, here's 2019, right? Same thing, DIA, the S&P 500, and we'll take a look at the triple Qs here in a minute. Once you understand that the correlations are so high and directionally is really what matters, you can see that the green periods for the DIA, the yellow periods for the DIA are virtually identical to that of the S&P 500. So I get a lot of questions on this. So I hope you're seeing that it doesn't matter. The correlations to the U.S. equities are so high these days. Everything is so highly correlated that if you can understand what's going on with the S&P 500, it gives you a huge advantage regardless of what you're investing in. So again, we're taking a look at the DIA for right now. Again, this is 2019. Now we're taking a look at the triple Qs, the black line overlaid on top of the S&P 500, and we're back to 2018, and we can see that directionally the triple Qs go in the same direction as the S&P 500, almost exactly the same direction at the same time. However, the rate of change, right, may vary, but the direction is what's important. So the green signal would be the same green signal that you would have for the S&P 500, even if you're using the Qs, or for those of you that like to use the leveraged Qs, you better get the direction of the market right, because if you own the long triple levered, the TQQQ, and the market starts to go against you, like when you're in a yellow or red environment, like towards the tail end of 2018, man, you can lose a lot of money in a hurry if you don't have the direction right. So I think you can see here by looking at the triple Qs, the black line overlaid on top of the S&P 500 during 18, that the direction of the stock market of all these different investments, the S&P 500, the DIA, the triple Qs, they all go in the same general direction. Now let's take a look at the triple Qs for September of 18 through March of 19, just like we did with the DIA. And again, you can see the black line, the triple Qs, going in the same direction as the S&P 500 during that time frame, during that downturn. And then when we look at the whole calendar year for 2019, again, the black line is the triple Qs, as you can see here, and it goes exactly, almost exactly in the same direction as the S&P 500. Again, the rate of change may vary, which doesn't really show up all that well on this particular chart, but you can see directionally that it goes in the same general direction as the S&P 500. And let's do one more thing now. Let's take a look at an individual stock. I get questions on this. So let's go back to 2018, and now let's overlay Apple, AAPL. Apple is the black line, and you can see that the correlation isn't quite as tight, but it overall is about the same. So you can see here that Apple peaked actually and started to go down before, back in the beginning of 2018, before the overall market rolled over and before the yellow signal came out. But you can see that overall, Apple is pretty highly correlated to the S&P 500 during 2018. And now, of course, we're looking at Apple from September of 18 through March of 19 during the downturn, and you can see that Apple pretty much followed the S&P 500 lower. Apple actually bottomed about a week after the overall market, which is kind of interesting. But you can see here that once the stock market started to go back up, then that allowed Apple to go back up as well. So individual stocks will, to a large degree, follow the overall market, but it's not uncommon for some stocks to lag when the market bottoms. Some of them will be exactly in sync with the market, but I've seen this on numerous occasions on some individual stocks that I track and trade where the stocks themselves will lag by about a week or so. All right. So now let's move forward and take a look at Apple during 2019. And again, you can see that directionally, right? Directionally, the rate of change may vary, but directionally, Apple goes in about the same general direction as the overall stock market. So that's just one stock, I understand, but Apple is extremely widely held, probably the most widely held individual stock out there. So I wanted you to understand that even if you're dealing with individual stocks, you need to understand, are you in a green? Are you in a red? Are you in a yellow environment? Okay. So, you need to understand this because it's going to help you irrespective of what your underlying investment is, whether it's the SPY, the DIA, the triple Qs, or individual stocks. Simple market signals will help you. And for those of you that are financial advisors or money managers, including hedge fund managers out there, because I do have hedge fund managers, financial advisors, other financial professionals, wholesalers for various financial services products that subscribe to Simple Market Signals, this gives you guys a massive advantage because you have information that you can't get anywhere else. I am the only person that has this model. I created this model. This is my system that I'm sharing with you for a very, very modest price. If you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here's some additional information. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.